We have all been told that the big bad wolf of trading is fear. We are told to fear the flash crash, to fear the black swan, and to fear the margin call. But I'm here to tell you that fear is actually your friend. Fear keeps you small. Fear makes you double-check your stops. Fear makes you hesitate when your setup is not present. The real killer, the silent, smiling assassin of the trading world, is euphoria. When you are afraid, you are hyper-aware. When you are overconfident, you are blind. You aren't looking for risks anymore. You're looking for a new car. You aren't calculating your risk per trade. You're calculating how much you'll have in 6 months if you keep crushing it at this rate. The overconfidence trap is a psychological loop where success breeds a sense of invincibility, leading to a total abandonment of the very risk management that created the success in the first place. It is the moment the trader stops being a strategist and starts being a protagonist in a movie that hasn't finished its script yet. To understand why busted traders lose everything, we have to understand the winner's paradox. Most traders who blow up don't do it because they are bad at technical analysis. They blow up because they are too good at it for a brief window of time. This creates a cognitive bias known as self-attribution bias. The streak. You have 5 winning trades in a row. The internalization. You tell yourself, I have finally cracked the code. I see the matrix. Everyone else is trading noise, but I am trading signal. The externalization of failure. If a trade goes wrong during this period, you blame the manipulation or bad luck. But the wins, those were 100% your genius. This leads to illusion of control. You start to believe that because you've predicted the last 3 moves of the S&P 500, you are actually influencing or mastering it. This is where the dopamine takes over. In the brain, dopamine isn't just about pleasure, it's about prediction error. When you win more than you expected, your brain floods with chemicals that sharpen your focus on the reward while dulling the pain centers that recognize risk. You are, quite literally, chemically intoxicated. You are trading under the influence. TUI. Let's talk about trader Alex. Alex spent 2 years learning the ropes. He was disciplined. He traded 1-lot contracts. He grew his account from $5,000 to $12,000. It was slow, grueling, and methodical. Then came the perfect week. Alex caught a parabolic move in a momentum stock. He made $4,000 in 3 days. Suddenly, the $12,000 he worked 2 years for seemed slow. He felt he had leveled up. Alex decided that the only thing holding him back from a millionaire lifestyle was his cowardice regarding position sizing. He thought, if I can win with 100 shares, I can win with 2,000. The chart is the same, so Alex loaded up. He used maximum margin. He took a position so large that a 2% move against him would wipe out 40% of his account. Because he was so confident in his read, he didn't just ignore his stop loss. He didn't even set one. He knew the price would go in his direction. Price didn't go in his direction. It consolidated. Then it dropped. Alex sat there, paralyzed by the endowment effect, valuing his position more than the market did simply because he owned it. By the time he hit sell market, he hadn't just lost his profits. He had lost his original $5,000 and owed the broker money. Alex didn't lose because his strategy failed. He lost because he mistook a winning streak for a permanent increase in skill. Now, let's look at trader Sarah. Sarah wasn't a gambler. She was an analyst. She had an MBA. She understood the fundamentals. She was an expert in the energy sector. She built a massive short thesis on an oil company. She had spreadsheets, She had data. She was 100% right on the math. Because Sarah was objectively right, she felt she didn't need to respect the price action. When the stock went up against her, she laughed. The market is irrational, she told her peers. They're just giving me a better entry. This is the belief perseverance trap. She was so confident in her intellectual superiority that she viewed the market's disagreement as an error by the market. The market stayed irrational longer than Sarah stayed solvent. A short squeeze triggered. Because she was so confident in her facts, she had averaged down 4 times. When the margin call came, it wasn't a slow bleed. It was an explosion. Sarah's story is a reminder. The market doesn't care about your resume. It doesn't care that you're right. It only cares about where the orders are being placed. Overconfidence in your intelligence is often more dangerous than overconfidence in your luck. How do you know if you are currently in the overconfidence trap? Look for these 4 symptoms. Number 1, skipping the pre-flight checklist. You used to spend an hour prepping. Now, you open your laptop, see a candle move, and jump in. You feel you just know where it's going. Number 2, narrative building. You start telling people about your trades before they're closed. You're cashing the check in your mind. You've moved from, if this happens, then I do that, to, when I win this, I'm buying that. Number 3, aggressive scaling. You find yourself increasing your risk not because your account grew, but because you're bored or frustrated with small wins. Number 4, the absence of fear. If you enter a trade and your heart rate doesn't change at all, not because you're disciplined, but because you think there's 0 chance you'll lose, you are in the kill zone. Every professional trader knows that every single trade, no matter how perfect the setup, has a non-zero chance of being a total loser. Overconfidence is the belief that you've found the exception to that rule. So, how do we survive our own success? We need a system for humility. The circuit breaker rule. If you have a God-tier day, a day where you made 5 times your daily average, you must stop trading for 24 hours. You are probably in a euphoric state. You might not be fit to make decisions. Go for a run. Play with your kids. Get the chemicals out of your system. The 50% reset. After 3 consecutive wins, force yourself to trade at 50% of your normal position size. This sounds counterintuitive. Why trade smaller when I'm winning? Because trading smaller forces you to focus on the process rather than the profit. If you can't handle a small win, you aren't ready for a big one. The pre-mortem analysis. Before clicking buy or sell, ask yourself, if I wake up tomorrow and this trade has gapped down 10% against me, what will be the reason? And will I survive it? If the answer is, it can't happen, don't take the trade. The journal of shame. Don't just journal your wins. Journal your lucky breaks. Those trades where you broke your rules, stayed in too long, but the market bailed you out anyway. Those are your most dangerous trades. Mark them in red. Remind yourself that you didn't win. You survived a mistake. The graveyard of the stock market is filled with geniuses. It is filled with people who were right for 3 weeks and broke by the 4th. The difference between a busted trader and a professional isn't the strategy. It's the ego. The professional knows that the market is a giant, uncaring ocean. You don't beat the ocean. You surf it. And the moment you think you own the waves under extreme conditions, that's exactly when you have a hard wipeout. Stay small, stay humble, and check your ego.